This year, my newsletter subscribers caught SMCI's 240% rally using just one of the chart patterns that I'm about to show you. Most traders overcomplicate their analysis, but these 11 patterns are all you need to spot winning trades. I spent years learning this the hard way, but today I'm going to show you how you can spot each of them in less than 2 minutes. And of course, if you stay until pattern number 8, I'll show you the exact setup that helped the people who subscribe to the newsletter to catch NVIDIA's 180% gain. In this video, you're going to learn how stocks like AMR in 2021 made a 340% gain in just 155 days. You will learn how INSW, which is a shipping stock, did a 160% move in 120 days. This is a move that you're going to learn how to profit from. You will learn how Li, which is a Chinese automotive industry, it did 80% in 90 days. These are very beautiful moves that you can easily learn. The first thing that you have to know is that impulse waves are the heart of wealth generation. But impulse waves come from bases because stocks actually spend most of their time sitting, and you don't want to be holding a stock while it is sitting because you don't know if it's going to sit for 6 months or just 1 month. Going on to other examples, Mara, which is a cryptocurrency stock, did 250% in 40 days after sitting down for 120 days. NVIDIA this year, we caught it very early at around $50. It is still going up, but this is the moves that it did. SMCI, you can see where we entered from the newsletter around $300, and SMCI went up to $1,000. Now I know that you're a very busy person watching this video and you probably don't have 20 hours every day to look at charts. That's why I'm stripping away all the complexity and I'm putting it all in the newsletter. You will receive exact buy and sell signals. And of course, you save yourself 20 plus hours every week. And while I'm showing you these setups, you're going to be learning about stock markets, of course, because I'll be showing the thinking process behind the picking of these stocks. Of course, I showed you our past winners that have happened in 2024. We had SMCI with a 240% return, NVIDIA with 180% return, HIM stock did a 60% return, Appfolio currently has done 80%, and Tesla did a 40% return. Before we go, I want to acknowledge the people that I'm learning these steps from. Of course, I've learned it from personal experience. A great trader called Constance Brown, please check her books out. Gil Morales, who wrote beautiful books, William O'Neill, the OG, Mark Douglas, the king of psychology, and Mark Minervini, the king of overall trading. These chart patterns that I'm showing you are something called bases. A base is when a stock is consolidating or it is sitting down and is waiting to spring up so that it can make a huge move. Now, a good base must be at least 4 weeks. 3 weeks is not a base. Of course, sometimes I'll trade 3 weeks, but I will be very careful. But most times you want to see something that is 4 weeks. Most bases that are to be trusted must have 7 to 8 weeks of price consolidation. And the first stage base, which I'm going to show you what that is later, needs to be having at least 6 weeks minimum. These are the patterns or the bases that we're going to be learning. Cup with handle, double bottom, virtual contraction pattern from Mark Minervini, 3C chart pattern, box and flat base, high touch flag, which is very important, ascending base, base on base, and something called the shakeout +3. So the first one is a cup with a handle. You want to see a base that is at least 4 weeks. Before forming this cup and handle, it should have at least a 30% move, and you want to see something which is a U shape and not a V shape. In the handle, you want to see something called a volume dry up. So when the price is increasing, you want volume to increase, but when price is going down, you want volume to be drying up, which shows that there's not a lot of people selling the stock. You want to see very tight price action. So in the charts, you always want to see prices that are not jumping around too much, that are not volatile. Of course, experience will show you what these are. And of course, you want the handle to be just about 8 to 12%. Anything more than that becomes risky. And this is, of course, relative to the volatility of the stock. And you want this handle to be drifting down and sideways. You don't want it to be drifting up because that is not normal. In this year, we saw it in FSLR, which is a solo stock. So you can see here, FSLR is forming something called a cup with a handle. So here you get your cap, there is a handle, it jumps out, and then the good buy point is here on $185, and you had a chance to make a 62% gain. The next one is Kavana this year. Kavana is still going up, but we can see that it forms a cap, it forms a handle, and then it breaks out on earnings, and that is a good time to get into the stock for a big move. We can see that in the coming 3 months, Kavana did a 92% move. One other interesting thing is that for such big breakouts like Kavana's, which has been jumping out of a base, you want to see huge weekly volume. So in order to see huge weekly volume, you want to be seeing the weekly chart on this side, you want to be seeing the daily chart on this side. So whenever it forms this big cup and handle that you can see here on the weekly chart, and it jumps out here on big volume, how do we know this is big volume? Is that on this week of the breakout, we can see that the volume was 73% higher than, if you see it down there, 73% higher than the average volume it normally shows. So that means that a lot of people were jumping onto the stock. And what happened to Kavana after it showed such huge volume? Currently, Kavana is up 200%. So if you put in $10,000, this is $30,000 into your bank account. Fix, which is a home building stock. We can see a cup with a handle here. We can see the handle, and then we could have bought, and then you could have made a 62% gain. The stock is actually still going up. So this was a very good move from 2023. PTGX, these patterns show up the whole time. I'm just trying to show you how you can catch them easily. You want to see it forming a handle. You want to see it forming a cup, forms its handle, and breaks out in huge volume. The next thing is a VCP base. This was named by Mark Minervini. So what you're looking here is you want to see a stock forming volatility contractions. So let's say the first time the stock corrects 20%, the next time it corrects 10%, the next time it corrects 5%. That means that the stock is contracting and it is waiting to jump out. And a lot of these bases or a lot of these patterns, many times they're interchangeable. Some people might see a cup with a handle, some people might see a VCP base, but it doesn't matter if everybody is making money. So you want to look for volatility contractions. You want to see tight areas that have low volume, and you want to buy when the stock moves above the pivot on expanding volume. This is very similar to the other bases. You want to focus a lot on price action and volume, but not the particular stocks. So here we have triple bottom. This is a normal cup with a handle, which shows two contractions. This is something which some people call an ascending triangle. It has 3 contractions. So the more contractions, I don't think it's necessarily better, but the longer it forms these contractions, the bigger the move is after. So we can see block. This is an ETF of cryptocurrencies. So a lot of cryptocurrencies were contracting. So you can see the first big contraction, the second contraction, which is not as big as the first one, and then the third contraction. And then you could buy there, and then you could have had a 20% gain in just a few matter of weeks. Of course, FSLR, some people, I say, see a cup with a handle, but some people see our VCP pattern. And there you could have gotten a 70% gain. Easy. Netflix, 2018. You see it forming a virtual contraction pattern. First drop is huge. Second drop is not as huge. Third drop is very slight. Volume dries up. We can see that very beautifully. And then it breaks out of the pivot. And then you could have gotten a very nice profit on that. The next is something called a 3C chart pattern. So 3C means they're chits. There's a lower chit, there's a mid chit, and then there is a handle, which is the high chit, I guess. So it only occurs in some stocks. So this 3C pattern is the earliest point that you want to be buying a stock. It's called a chit because you're cheating and you're entering the stock before it actually breaks out of the consolidation. So there are 3 types of locations. It could be in the handle, which is the normal part that I've showed you before, like the cup and handle. There is a mid chit, which normally happens in the mid of the base, and then there's a low chit, which happens in the lower third of the base. Now, of course, as time goes on, these names won't matter a lot. These names are only very useful when you're learning and you're trying to know what to look for. But as experience comes, you won't even be thinking about the names. You'll just be intuitively understanding what you have to be doing next. So this is COS, which is an IPO that happened this year, and it was a very beautiful pattern and it went up a lot. This pattern here showed up here at around $3. The stock currently is $13. So the stock went up about 3.5 times, which is a very beautiful profit. So what happened? So you can wait for a stock to go into a downtrend. In this instance, it was an IPO. You wait for the price on the right side to recoup at least a third of the decline. The stock will pause and form a plateau area. What I like to do is actually use the 20-day simple moving average to give me a hint, because if you're very extended away from the 20-day moving average, that means the stock is going to be extended. But if it's closed and it's forming its chit near the 20-day moving average, that is a very beautiful thing for me. The stock pauses from the plateau area. You want to see it forming a little bit of a shakeout, so it checks out some people. You want to see the volume drying up, and then you want to see it break out from there on a little bit of volume. Then there's something called a lot chit. This happened in CLSK 2024. This forms in the lower third of the base. It's very risky because in the lower third of the base, that means the price is very weak and there are a lot of sellers up here who are looking to dump the stock on you. So that's why the low chit is very risky, but this tight price action is forming in the lower third of the base. So to see it on the real chart, so you come onto your weekly chart. I told you want to see at least 4 weeks of consolidation. 1, 2, 3, 4. We see 4 red bars here. The reason why this was a very good chit is because the 50-day moving average was very strong. So there are other things which you have to bring in to help you analyze these bases or these patterns so that you can profit from them. One thing that is going to be very important is having the 50-day simple moving average to this black line, the 20-day simple moving average. So those are my daily chart. And then on the weekly chart, I have my 10-week moving average, which is the equivalent of a 50-day on the daily chart. And then I have the 30-week moving average, which is equivalent of a 150-day. So here, the reason why this was a very good entry and it was safe, despite the fact that it was a low chit, is that the 50-day simple moving average was sloping up. That means that the trend was very strong. As soon as it broke out here, it's also moving above the 50-day moving average. This is a very strong buy. Just buy it here, and it went up 144%. We can see ASC formed something called a low chit. This is also very similar to something called a double base. So a low chit is when it comes and forms a chit in this low area of the base, and then you could have bought it there, and then you can profit. So seeing this on the real chart, this is how you'd have known that this is a very beautiful move. First of all, on the weekly chart, the trend is very strong. We can count at least 4 weeks of it consolidating because it started here. 1, 2, 3, 4, 5, 6. Very good. From the chart right along the 50-day simple moving average, you can see this tight price area. There's volume dry up down here, and as soon as it moves up here, this is a very good time to buy. And what happened? 60% move, just like that. Everybody can do these things, guys. I just want to teach you how you can do them over and over again. So Google in 2004 forms a very low chit here as an IPO, moves up 94%. This was a very good entry. The next that you have to learn is something called a double bottom base. So what happens in a double bottom base is that the stock will come up, form something like a zigzag. We have a middle of the W pivot, and you want to see at least 4 weeks of it doing this thing. Now, what you have to know is that many times the second bottom will normally match the first bottom, or it will undercut it, and that undercutting it is a very good sign, as I'm going to show you later. For someone who is very conversant with Elliott waves, this is something called a zigzag. But for someone who is more conversant with the canceling practicing, then just call it a double base or a double bottom. Now, if you want to know if your double bottom is not really that good or you shouldn't get into it, the first thing that you don't want to see is this middle of the W getting, above the high of the first shoulder. That is a very bad sign. Another bad sign is if this second bottom does not slightly undercut the first. That is also a sign that you should look out for in these double bottom bases. So these are very beautiful double bottom bases that I found while going through my weekly chart. So here we have the weekly chart, and then here we have the daily chart. So you can see something which is double bottom or zigzag, whatever you want to call it, comes here, shakes out a little bit, and then moves. This is an NVO, ASML. This is something which people call a double bottom, as it undercut here. And then what you're waiting for when you're buying the double bottom is you want it to Once it clears above the middle point of the W, then that's when you buy. So here we see the undercutting and then it rallies again. So this is what we called our double bottom. So we're waiting for it to cross above this 130 line. But what are other good signs? First of all, we can see that the 50 simple day moving average is sloping up. The price is above the 30-week moving average. That is a very good sign. Whenever it does that and then it jumps above the 50 that is also sloping up, that is a very good entry. Now for this particular one, since it gapped up, I would have entered here at 126. My risk would have been about 2%, and the potential profit was 15%. A lot of people won't get the whole 15%, but that is a very good risk to reward ratio. ASML in May of 2024, how would we handle that as well? ASML and form this thing which kind of looks like a double bottom, but it's more like a zigzag. So what should you have done here? So here the 50-day simple moving average started to slope down, but the 30-week moving average was still sloping up, meaning it is very strong. And then it did come up here, formed like a shakeout from this level, and then form tight price action here. So what you normally do is you wait for it to come up above the 20-day simple moving average. I would form a line here. I want to see it jump up above my 50-day simple moving average. So it jumps up my 50-day simple moving average here. So I would have bought here, and my stop would have been around 4%, and the maximum price it went up was about 16%. We normally don't want to hold through earnings, but even if you held through earnings, you could still have broken even, but you had the potential of making a nice profit on this trade. Not the best example, but that's how it is in the real world. It's never as beautiful as in the books. ATKR, we see this one was a very good one. Forms a zigzag or the double bottom. This is our pivot point. We are waiting for the price to move above that pivot point and we can buy. But actually, I normally even buy before. So if I look into ATKR, in May of this year, what are the good signs that I'm looking for? So it forms this sort of zigzag pattern. The reason why for me this was a very good buy is that it has like a triple bottom here. You can see it checking out a lot of people. And then it jumps up above this line. It has formed at least 4-week consolidation. And then there's this big candle here. Ideally, I would have bought around here at 161. My stop would be about 5%, 5.6%. Potential profit was 20%, so a risk to reward ratio of about 1-3 or 1-4. Not the best trade, but it was still nice, and it fell on earnings, and also there was a good opportunity to short it here. The next type is something called a flat base. So a flat base is when the price moves up and then just consolidates in a flat area for 5 to 6 weeks. It doesn't correct more than 10 to 15%. This one is very rare. I rarely see it, but I got some examples for you. So we can see here the stock goes up, and this particular stock only consolidated in this flat area for just about 7%, and then it went on to perform a big move. You don't see a correction that's more than 15% for these flat bases. The most beautiful flat base I saw in 2024 was VITL stock. So VITL, we'll look at it in real life. So what happened to VIT? So we have our flat base here. Now, while I'm showing you bases and chart patterns, there's a lot of things that come into this technical analysis that help you to see that this is a good stock. Now, despite the fact that this was a flat base, if you look at this earnings table, it is beautiful. It's a very good earnings table. But let's go back to our flat base. So you see it consolidating here on the weekly chart for a very long time, forms this big cap and handle. Whenever you see this such big caps and handles, that means that this is a move that is going to move for months. And once it breaks out and you see the volume above 50, and if you see the volume on the weekly chart is above 100%, that is an A+. 100% above the average volume it has done in the last 50 weeks. If you see that and it's above 100%, man, that is a stock you need to get in. So here we can see there was that very big volume. It did form a very flat base, which means a lot of people are not willing to sell. So this area here was pretty much a flat base. It's never as beautiful as in the books, but we can see that the consolidation here was just about 9%. Now that is very tight. And what happened to this stock, my friends? The stock jumped out and went up 3 times. If you put in 100,000, it turned into 300,000. So this was a very beautiful move this year. I liked it a lot. Back to our examples. The next one is an ascending base. Now this one is a very tricky one. So a lot of people are not likely to catch this one. We're looking for 3 declines, and we want to see each decline forming a higher low. And then hopefully it forms a new high. It forming 3 higher highs is not a must, but if you see 3 new highs, that's good. If you see 3 pullbacks, 3 higher highs, 3 higher lows, that's a very strong signal. This is a very strong signal, this ascending base. So this particular chart is BLBD this year. This is the stock I actually traded. So let's see what happened in BLBD. This was a very tricky ascending base. Remember, we're looking for a stock that consolidates for at least 7 weeks in total. So now sometimes those consolidations happen in bunches of 2 weeks. They happen in different stages. So the first one is, it forms here the first consolidation. Then it moves up, forms here another one. Then it moves up again and forms here had one. So this one is very tricky. A lot of people are not going to catch this. The reason why I just consider this one base is because if we were to look at the price, it really peaked around $33. So it was moving around $33 for a very long time. For about 83 days, it was just around. It really didn't go anywhere. It looks like it's going up and down, but the fact is that the price didn't go anywhere. So this is something called an ascending base. And then what happened is that there were good earnings, which is something you have to get used to. A lot of these big moves have earnings in them, and that propels the stock further. But a lot of times you'll see the stock moving before the earnings. That is the truth. So you can see the stock was forming these bases here. I had bought it already here at around $25, so I really didn't mind these ones. And then it came and shook out people here. I held on. Once it jumps up on earnings like this on very huge volume, you can see here in the weekly chart that is very big volume. That is a good time to add to your position actually. And then after it jumped out on volume, it did a very quick 30% move as well. So in total, whoever bought this move from here around $25 could have made around 130% return on their money. Okay, so there's BLBD. We can see what happened. It's a very tricky base to catch. The next one is something called the high tight flag. So this one, the criteria is you want to see a stock moving 100 to 120% in about 4 to 8 weeks. Then you want to see the stock moving sideways, only correcting about 10 to 25%. So it's resting for about 2 to 5 weeks. You don't want to see it correcting too much. And after it does that, it's just likely to jump out. So I have an example here. This is Digital Turbine, which is apps. We can see it moved up 160% in less than 8 weeks. Then it forms this very tight consolidation here. And as soon as it jumps out there, it does a 150% move. And there's earnings in the middle there. So a lot of these moves are actually fueled by earnings. That's one thing I realized. So these high tight flags are actually very rare. I have another example for you here. This one had moved 470%. From the very high tight flag, you can see the price isn't going anywhere. People don't want to sell that thing anymore. And then it just jumps out and does an 80% move. Very easy for a lot of people to catch that one. Normally a company has new products. One of them is very profitable. And then the good thing about this high tight flag is that you don't even need a lot of strong fundamentals for the company for this particular setup. And you also have to watch out for something called the late stage base. I'm going to teach you that later. But these high tight flags normally happen in smaller companies that a lot of people don't know about. It's not going to happen in Apple. I mean, it can, but it's very rare for 3 trillion to be going up 5 times. So that's going to be crazy. So we also have X here from the very good high tight flag, did a 30% move. You could have profited from that. Elon Musk's company. Twitter, the next pattern that you're looking for is something called an IPO U pattern. So when these stocks form an IPO, they just come from this U pattern and you can just come and get in here at the base and then you could have got a nice profit. We can see it happen in Google as well. Comes in here from the U pattern, jumps up. The next one, which you have to really know, is something called a base on base. Now this is a very strong signal because now what the stock has done is that it has formed a consolidation on top of another consolidation. And normally after stocks do this, they just erupt. For example, Oracle came and formed a cup with a handle. So a lot of people must have bought here. They're like, hey, it's going to jump up. But then it jumped out and then it just sat again for another 4 weeks. Very disappointed. But then I'm like, hey guys, don't be sad. This is actually a very strong signal. And as soon as it jumps out, it moves from $11 to $28, guys. That's more than ×2 of your money, a base on base. So we can see it here. It happened in Wing 2024 as well. We see it forming here a consolidation and forms another consolidation on top of that. These are very strong signals. Whenever I see this one, you just know it's likely to jump up. We see it happen in Fix after our beautiful cup and handle. We expected, hey, just jump out. But then it's like, no, I'm not jumping out. I'm sitting for another 4 weeks. It sits. And of course, as patient people, we wait for it to jump out. Boy, it did a 62% move in a very short amount of time. The next chart pattern that you want to master is a box base. Now, this is, of course, just like the other bases. A lot of people just have these names, but when you see it on the chart, it's going to be easy for you to see. 4 to 7 weeks, you don't see a correction that's more than 10 to 15%. It's very interchangeable with something called a zigzag, an Elliott waves or an Elliott wave flat. A lot of people might also just call this a double bottom. So you're waiting for the price to cross this line of least resistance. As long as when it crosses that in very huge volume, that is a very big sign for a long move. So after you've mastered those patterns, you also want to know, when are these patterns wrong? What is a faulty base like? A faulty base is something you don't want to see. You don't want to see something which is called a late stage base. You don't want to see bases that are very wide and loose. This is not a good sign. You don't want to see V-shaped bases with no handle. That is also a very bad sign. You don't want to see 2 weeks down, 2 weeks up. You don't want to see very heavy red volume in the base. So here I show you all the bad signs that you don't want to be seeing in a base. So here, Sage in 2022, we can see it forms this very long base. And of course, if you're like me, you're waiting for it to jump up on huge volume and you're like, man, this is going to be a huge move. But boy, it just failed and disappointed all of us. So after you've mastered those, you need to master, how can I buy these things? So we want to master the entry types. So you can either enter at the pivot point, you have to master entering at gap ups, you have to master buying on a cheat, you have to master something called the shakeout +3 rule. This is normally on double bottoms. And then there's also something called the rule of 3. So once you master this buying criteria, then it becomes easy for you to profit from all the bases. So the pivot point is where the stock crosses the line of least resistance. So after you've seen volume contraction and it jumps out from the pivot, you want to see volume expanding there. You want to see at least 50% increase in volume compared to the average, the 50-day average of the volume. And then we can see what happened in NVIDIA. This is the same thing for SMCI. It forms this very long base. We can see all of these contractions, and then it just jumps out on huge volume. Now, a lot of people would be scared to buy on such a huge bar, but this stock actually tripled in just 50 days. So that was a very good sign. The next thing is something buying in a cheat, because sometimes if you wait for the pivot, it's going to be too late. And for these bases which are not taking as long as 5 months, the move after is not going to be that huge. So normally you have to get in a little bit early, and that's why you buy in these cheats. So there's a low cheat, and then there's something called a mid cheat. So you should use this 20-day simple moving average to guide you. So here in this particular stock, I remember this must be CLSK. The stock forms this consolidation, forms a low cheat, as I already showed you earlier in the video. Once it forms that tight price action, you buy it. The next thing is a mid cheat and a handle. So the low cheat is in the lower third of the base. The mid cheat is in the middle part of the base, and then the handle is in the upper third of the base. So here we have a mid cheat, and then we have a handle. So we can see the consolidation very clean. And then it forms a cheat. So that was a good time to first buy. You can take a position there, and then we can see the handle, and then it jumps out again on huge volume. The stock then moves 70% in just a matter of days. Then the last one is something called the shakeout +3 rule. So this normally happens on double bottoms. So this was developed by Jesse Livermore. If there's a shakeout on a double bottom or a triple bottom, add 3 points to the first support low, and then there is your new buy point. So this normally is for stocks in a $20 to $40 range. Alternatively, you can also use a 10% move from the first low as an entry. So here we can see there was a triple bottom. It comes and shakes out a lot of people here who had put their stops right below. And then it jumps out on earnings too. So these are the lot of things that were coinciding. This was a very good buy. Did 40% in 2 months, but the risk here was about only 3%, so that's a very good risk to reward ratio. And shakeouts are very good signs because it shows that people are trying to scare out other people. People with the big money, they scare out the weak holders, then they come in and just scoop the stock for themselves. So what is the rule of three? This is not really a rule, it's just like guidance. So normally, sometimes when the breakout happens, the stock will fail. But a lot of times it succeeds on the third breakout. So a lot of the time, the third breakout, most of the time works because people have been conditioning to think that, hey, it's going to fail. Don't get bogged down in the details. Just try to understand what is happening. You want to see volume contraction, you want to see shakeouts. Once you understand the psychology, then really all of these patterns are not really going to matter to you. You're just going to think of them as just educational material, but they won't really matter because you're going to instinctively understand what is happening in the stock. This is mostly for beginners to understand what is going on. So, of course, for long-term buying, these are the final buying guidelines. Best one and best two are the best times to get into for longer-term holdings. So best one and best two come after the stock has been consolidating for a long time, maybe 3 months to 6 months. And after best three and best four, normally those are very weak. You don't want to trust them. A lot of stocks actually don't even reach base three and base four. They just have base one and base two. That's why base one and base two are the most trustworthy. Base three and base four, once you see them, that means the stock is becoming weak. And the way you can know that it's a base one is normally when the 150-day or the 30-week moving average is flat. So once it breaks out of that, and then the 30-week moving average starts to slope up, then now you're in stage two. And that's where base two, base three, and base four normally happen. Base five and base four will normally happen in stage three once the stock is now flat again and is just looking to crash. So base five and base six, once you see a stock having 5 to 6 bases, please be very careful. Try not to get into the stock if you're not very conversant. Only for professionals. Beginners just stick to base one and base two. There will always be a base one and a base two. That's the truth. And one thing you should also know is that big winners are seldom through until they've undergone a 20% correction. I hope you've learned a lot from this. May the markets be with you.